The stock for BigBear.Ai Holdings, Inc., ticker BBAI, is currently trading at $6.25 per share, reflecting a decline of 2.67% in intraday trading as of 12:20 p.m. EST on Wednesday, November 26, 2025. This downturn, while seemingly modest in raw dollars, is significant because it is a direct retest of the crucial $6 psychological and technical support level that has recently played host to intense battles between buyers and sellers. The expectation on the street is that a company like BigBear.Ai, which operates squarely in the high-growth artificial intelligence and national security sectors, should be exhibiting more resilience, especially following the recent buzz around their Q3 earnings and strategic maneuvers. The reality, however, is that this stock is exhibiting the classic behavior of a heavily contested small-cap growth name, where fundamental improvements are being overshadowed and often neutralized by the very real pressures of market microstructure, primarily short-selling activity, and overall risk-off sentiment in the broader tech sphere. The general belief about BBAI, especially among retail investors who track the AI narrative closely, is that its focus on government and defense contracts provides a stable long-term revenue base, setting it up for eventual profit stability that its commercial-focused peers lack. The deeper take, which the intraday chart is trying to force us to acknowledge, is that this stability is currently a double-edged sword. While it's true that long-term contracts offer predictable revenue, they often come with lower margins and are slower to scale compared to enterprise commercial platforms, which means the company's path to sustainable GAAP profitability remains a significant question mark. This tension between high growth potential and ongoing cash burn is precisely what fuels the volatility we're seeing today. The move down to $6.25 from an open near $6.27 and a high of $6.30 demonstrates sellers capitalizing on any short-term weakness, keeping the stock range-bound despite the broader interest in defense-adjacent AI stocks. The sheer volume on this decline is also telling, currently sitting well above 27 million shares traded, which suggests substantial liquidation pressure or profit-taking after the recent run-up that followed the Q3 earnings release in early November. Breaking down the recent stock movement, the catalyst for the last major upward swing was the Q3 earnings report, where the company actually managed to exceed Wall Street's revenue expectations, reporting $33.1 million. This was immediately followed by the announcement of the Ask Sage acquisition, a generative AI platform deal they project will bolster their annual recurring revenue, or ARR, for that specific platform by six-fold, aiming for $25 million in 2025. That sequence, a financial beat, and a forward-looking strategic acquisition created a surge, pushing the stock from the $5 range and re-establishing the higher trading band we are currently observing. This is the expectation part of the equation, that BBAI is executing on its strategy. The reality check comes when you look at the fundamental metrics that remain deeply in the red, such as the extremely negative EBIT and net income margins, which are figures that institutional funds cannot easily overlook, especially when evaluating a company that trades at a hefty price-to-sales ratio, significantly higher than the industry average. The current weakness is likely a correction from the initial, perhaps over-exuberant reaction to the news, as investors now settle back into analyzing the long and uncertain path to profitable growth. Now, let's pivot to the crucial element of short selling that is actively suppressing upside in BBAI. This stock is indeed under significant short seller pressure, a factor that is top of mind for a lot of retail traders. Current data indicates a very high level of short interest, nearing 80 million shares, which represents a short interest percentage of the float close to 20%. Any stock with a short float this high is inherently volatile and is being viewed with extreme skepticism by a meaningful segment of the market. The high short interest is the practical expression of the short thesis, that the company's valuation is speculative, driven by the AI hype cycle rather than sustainable high-margin revenue and profits, and that the recent surge was an opportunity to establish new, profitable short positions at a higher price point. The good news for those holding long positions is the days to cover metric, which is currently sitting well below 1 day. This number, which divides the total shares short by the average daily trading volume, suggests that if the short sellers were suddenly forced to cover their positions, a short squeeze scenario, it would be a very rapid, explosive event, but also perhaps short-lived because the number of days required to cover is so low. However, this is countered by the short borrow rate, which, while variable, has been rising recently. A rising borrow rate signifies increasing demand for short sellers to borrow the stock, which suggests they are not abandoning their bearish stance and are willing to pay more to maintain their positions, often a sign that a major short firm is actively defending their price targets. Retail investors need to be vigilant for coordinated short attacks, which often manifest as sudden high-volume sell-offs in the early hours or late in the day. A pragmatic response is not to panic, but to monitor the off-exchange short-volume ratio, which shows a high percentage of short volume occurring away from public exchanges. If this ratio spikes dramatically on a down day, it can be an indicator of aggressive shorting activity, though it is not conclusive proof of manipulation. For those looking to track this, platforms like Fintel and institutional filings via the SEC's 13F forms can provide the most recent short interest data and highlight which large institutions like Citadel or other hedge funds may have large net short or options-based positions, although the latter often remain opaque. The BigBear.Ai business model is rooted in providing predictive analytics and artificial intelligence solutions, largely to the United States government's defense and intelligence communities, which they categorize under their government sector, and increasingly to commercial customers like logistics and manufacturing firms, which falls under their commercial sector. Their core technology uses machine learning to process massive, disparate datasets and deliver actionable intelligence. Essentially, they help clients make faster, better decisions based on complex data streams. Think of it as an AI brain for decision-making in mission-critical environments. Their older performance history shows a company that has executed on key government contracts but has consistently battled the challenge of translating that specialized, high-cost work into the high-margin, scalable software model that Wall Street typically rewards with a premium valuation. The recent net income figures, while showing volatility, have been generally negative, reflecting the heavy investment required in both technology development and the substantial sales and marketing overhead needed to secure these major contracts. Looking forward, the future outlook for BBAI is a classic growth stock dichotomy. The expectation is that the acquisition of Ask Sage and the company's continuous push into generative AI and commercial logistics will finally provide the leverage needed to swing to profitability. Key catalysts to watch for are major new government contract awards, particularly ones with higher margin structures, and any significant enterprise wins on the commercial side that validate their scalable platform approach. Furthermore, the company's robust cash position, which reached over $540 million at the end of the last quarter, provides a solid cushion against immediate liquidity concerns and allows them the freedom to continue their strategic acquisition strategy without immediate need for dilutive equity raises. This is a crucial point that the market often overlooks in its fixation on the negative net income. The major risk, the counter-reality, remains execution and competition. The AI market is unforgiving, and much larger, well-capitalized players like Palantir and the major cloud service providers are also aggressively pursuing these government and defense contracts. BBAI's success hinges not just on securing contracts, but on transitioning to a higher-margin, subscription-based model that can truly leverage its intellectual property across a wider customer base, reducing its customer concentration risk. If they fail to demonstrate operating leverage in the next few quarters, the short thesis will gain significant momentum, and the stock will likely be punished severely,